Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. It is December 9th. It is the Tuesday live stream. Hope you guys are having an awesome day. As always, nothing I talk about here is financial advice in any way, shape, or form. It's just what I'm doing, what I'm looking at. You can see my sign is green today, which means I'm making money. That is typical here because I do a ton of trades that have non-directional trading. And so I'm relying on things like theta decay to kind of push money into my account. Also playing cash secured puts and all sorts of fun diagonal trades and crazy setups that can get super complex. So I would love to know from you guys today if you are, how long you've been trading options. Have you traded options before? Let me know in the comments here on YouTube, and let me know how long you've been trading options. I've been trading options since 2014, so coming up on 12 years. I've been trading stocks since 1996, so that's coming up on 30 years. I can't believe how fast the time has gone, and I still love it. And yesterday I was talking to a friend of mine, and we were talking about trading versus long-term investing, and really the goal of most traders is to make more money. And I think that some people overtrade. There's lots and lots of ways to make money over time, and we don't have to necessarily be trading all the time in order to make money. So today I'm going to focus on a couple things. I'm going to focus on trades that get put on that are designed solely for the purpose of making some money. And we're going to take a look at that. So let me know if everything's working. That would be fantastic. I see there's 6 people online, which is great. Say hello. Let me know where you're watching from. And please let me know that my mic is working. And otherwise, we're going to get right into this. And we're going to take a look at what is going on in the market. So globally, we're looking at the TSX up 0.4%, NASDAQ up 0.21%. I kind of love this global map here that we have on Moomoo Financial. So if you guys aren't familiar with Moomoo, they are one of the sponsors of this channel, and I do have links down below if you want to use their service. It's pretty awesome, especially for Canadians, because we get very inexpensive option trading. So I love that about Moomoo Canada. S&P 500 very, very flat, 0.06%, NASDAQ up 0.21%. In the Asian markets, we were all down today, down. So Singapore up slightly, but mostly down. Australian market down 0.5% today. We're going to look at those same things. We're just going to look at trading view quickly, and we're going to see where we are kind of in the cycle. So this is the chart, the daily chart on SPX, and we could see here that we're inside the Bollinger Bands. We're definitely above the VWAP over the long duration, and we are. Thanks, Ryan, for letting me know that I'm working. Appreciate it very much. And where we are, we're in the top of this range. We're right along this blue trend line. I know I've got a lot of lines on here. I did draw this blue trend line quite a while ago on here, and we can see that kind of moving up over the course of the last couple of months. And we are hugging very, very close to that trend line. We have broken below it. There, you'll also see that I have a couple of indicators on here that indicate long and shorts. You'll see there's a blue indicator that was long here and a short at the top of the Bollinger Band. We recently saw a long signal here on SPX, and we saw that quite frequently on a ton of underlyings. So there was a potential bullish move. Now we're a couple days into December. Today's December 9th. So is the Santa Claus rally coming? Are we going to hit 7,000 by the end of the year like some firms are speculating? Of course, we don't know. Always, we just don't know. So what we have to do is take high probability trades. That's what I do. I like to take trades that are paying me all the time. So let's look at NQ. Similar trend line on NQ. You can see that blue line here, and we're inside of the Bollinger Bands. No long and short on NQ here, but we're up 0.18% today, and we're just starting to see this shape forming here, and really getting into potential consolidation. So are we gonna go up, or are we gonna go down? Really hard to tell. Concentrating always on VWAP. I mean, we are above the volume weighted average price. So just take that into consideration. Whenever I'm looking at positions like this, I am expecting that there will be some sort of corrections in here. That is more typical than it is not. Similarly to when we were above earlier in the year and we saw this correction below, once we got down below the VWAP, we expect to have some sort of recovery at some point in time. So that's kind of how these work in general. So if I was trading NQ, what I would do is I would be looking at VWAP and saying, well, this would be my break-even area. I would want trades that make money above this level of around 22,649. And it's currently trading at 25,702. So that's a fairly significant range. Hi, Terry. Good to see you. Thanks always for joining. Appreciate it very much. Let's look at the Russell. We're up today, but again, Russell, similar sort of scenario. We are getting very, very close to the top of the Bollinger Bands. We're well above that volume weighted average price. So just something to consider as we're moving forward. The VIX is very complacent right now, 6.60. So it's down below its average. So if we see a VIX spike, this is when I would look for opportunity to sell premium into that VIX spike. US oil trading at $58 a barrel. I keep wanting to put on a trade. I just don't exactly know what the trade is that I want. Typically what I do with these is I play like a Jade Lizard type setup where I have a short put, which has unlimited risk to the downside and limited capital appreciation to the upside, but playing the range. And where that range typically for me is between $64 and $60, and we're trading below that. So it's really hard to say what is going to happen here if we're going to see a breakdown, but you know, I'm waiting to see one way or the other what's going to happen. If these lower high or these higher lows that we're experiencing is a really good sign. So if we dip down here again and we touch this lower Bollinger Band, I would expect that I will be going into a long position at that point. We've had 2 days of pullbacks. So gold still way up and tightening range on those Bollinger Bands. So we can see how tight those are getting here, but we're at the top of its range. So lots of potential fast movement to the downside on gold. This is where I would only trade limited loss setups on positions that are just screaming to the upside. Silver, big push today, up 4%. My patrons know I have a long silver position on. So looking for a huge breakout to the upside in silver, and the specific trades are in my Patreon and my Drawbridge Traders Club service. So if you're interested in that, you can check that out over there. Let's look at some of the Apple stock. We'll just kind of run through some of these quickly. Apple very much at the top of its trading range. TDT still down in the lower part of its range. AMD, we got a long signal just recently. It's come back up. My price range on this is between like 240 and 195. So for, you know, when I talk about ranges, that's kind of how I look at this. So that's my profitable window for AMD over the next, not very long, only till December 19th. So if I was to draw this rectangle on here, I would come up here to 240, and then I would come down to that 195, and I would come out to December 19th. So approximately like that. That is where I want AMD to be. So it's coming right into where I expected. And some of these trades have been on for quite a while. One of those trades has been on since prior to the earnings, or to this giant gap up that we incurred. So I have a trade that's coming into fruition here that I will likely be taking off. And, you know, we were in the upper portion of the band and I was playing a little bit longer range, like a cone. As I get tighter to the expiration date, I tighten these up as much as I can. I kind of adjust that trade and manipulate it into where I think it's going to be. ARK-K, there was a long signal fairly recently, but we're in the upper portion, still above VWAP. If you guys have questions about specific stocks, I would love to look at a stock in the range of between about $150 and say $400. If you guys have a particular stock that you might be interested in, I want to see if we can set up a zero loss trade on that. And I'm going to do that live. I'm going to show you how to do that in the rolling options record keeper. And this would be a trade that I would want to put on for a longer duration. So something that I might want to hold, say a stock like Tesla. I don't want to use Tesla because everybody always looks at Tesla. So any stock other than Tesla between $150 and $400 per share. And what I want to do is say, can I get consistent capital appreciation off of this with zero risk? Zero. Can I do it? I'm going to show you how I think about these trades, and then I'm going to show you how I set up complex trades in the rolling options record keeper and how it has transformed my trading style. So the Amazon trade, we saw a long signal a while ago when we were down right just above the VWAP, and here up at the Bollinger Band, we got that sell signal to get out of it. So that would have been a nice profitable trade had we taken that. And now we're down in the lower portion, and the lower Bollinger Band is right with this VWAP. So again, you know, where would I be setting my my break evens on Amazon? I'd probably be placing them right around that 214 level. There's a few other configurations I use for that, but once you guys ask me about some particular stocks, then we'll pull up that information. And if you want to talk about any other stocks, even out of the price range, feel free to just type them in the chat. Let me know. The sooner you get in with a message, more likely it is that I'm going to cover it, and I'll show you how I would trade it today. Now, Baidu, look at this long signal that triggered here, like right there on the Bollinger Band, and we're supposedly still in it, but we were very, very close. Well, the way that these trigger is when the stock is trading on the bottom side of the Bollinger Band, there's a long buy signal, and then when they trigger, or when they hit the top, and we're talking about this particular range here. So let's turn off one of those. VWAP crossover, let's turn that off, and then that's the Bollinger Band strategy. And so you can see how that functions. Basically, if we were looking at that just from a range perspective. Now, you can see that I like to have that other indicator on there as well, and this is that RSI. I shouldn't do this live. There it is. That's that little RSI strategy. It's Bollinger strategy as well. And I like to have both of those on. And it basically just shows me where I am in the longer term range and in the shorter term range. But we could take a look at Baidu. I mean, that kind of falls in the category of what we're doing and what we're not. David is asking if I'm still doing the Black Swan hedge. I am not doing the Black Swan hedge as laid out in my Black Swan hedge. One of the issues for me is that as a Canadian, those trades take up a huge amount of margin capital. And my brokerage, the last time we had a major sell-off in August 4th of 2024, they closed some of my positions that should have been winners. And they closed them for absolutely ridiculous prices. So that was an unfortunate mishap that happened, but it means that I don't like to be a trader that makes the same mistakes twice. So if I get burned on a trade because of my brokerage, then I have to assume that my brokerage is going to burn me again. So as a Canadian, I'm not trading the Black Swan hedge. Is it a great trade? Absolutely. Would I be trading it with $3 options on ES? No. The market is way higher than when the parameters of that video were released. So I would be looking at, you know, $7 entry or something like that on ES. But similar, people ask me all the time, they're like, well, how do you deal with this when the spreads are too tight? Let's go over to Moomoo and just take a look at ES for a second, and I'll just show you why I wouldn't. Wow. It's funny, I never look at the futures, or haven't looked at them. How do we get to ES futures? Kind of hard for me to show it on here if I can't find it. Okay, well, that's not going to work. I mean, SPY, we can kind of do the same thing. People do play it on SPY, but again, this is a margin requirement thing. So when we're selling short puts on SPY, the margin requirement is high. The Black Swan hedge that I made the video about specifically is using span margin, and it's for utilizing the fact that we would have less margin requirement than is required right now. So if we were to do it with SPY, you know, the $3 puts, and again, this is a poor example because it was not designed for this. That particular trade is used for span margin because it does take up a huge amount of margin requirement. And the max loss on trading this right here is 54,000 on SPY. So if I was to set this up and sell 3 of these contracts, you know, it's a $162,000 max loss to start the trade. And we just can't do that realistically. The margin requirement is too large. When you look at the curve, it's actually quite a bad curve when you start setting it up. So typically what you would do is you would set something else up with a shorter duration, shorter long calls, or shorter long puts. But what's going to happen is that, say we were to do that right away, so we were to buy some, let's say we buy, so we're getting $900 for this, right? So you buy 2 times 450 even, just to give yourself some downside protection. So if we bought 2 of these at the 645, what would this look like? So the max loss is still 33,000, max profit is 135, and the curve, there's your kind of profit curve. That's what's happening. The question is, do you lose money in here if this declines? So what you'd want to do is adjust this, but this is not the black swan hedge. This is not how it's set up. This is the effective return of what we could get from it. If we were to buy these shorter duration puts, let's just buy the 612. Yeah, so it's actually creating a little bit deeper valley of death, but that is a short delta trade. It's the kind of the idea with it. 83% probability of profit. Now, if I wanted to do this similar setup, what I would probably do is just do a like a 441 trade. So we're going off on a little bit of a tangent here, but for most hedging, if you were to go out, 45 days, and you were to find the $4 put, and then what you want to do is find the put that, or the spread that's $5 wide, that is $1 to buy. So if we look at the 655 for 536 and the 660 for 617, that is too expensive to buy. That's going to cost me 70. That's going to cost me 80 cents. So if I sell this and buy this, scroll this up. This is going to be the 660s a buy. The idea for this is you get into it for nothing. There's a credit of 93 bucks. This might not be a bad trade at all. But that gives you a big fat profit tent. SPY's trading at 683, and you can see the max loss on this is 62,000. So it is a different type of setup. It's 94% chance of winning. This type of trade is not a black swan hedge. This is like a midterm hedge. This is, protecting from this downside between 624 and the current price. So these are potentially income trades if somebody wants to trade it. Now you can use that 90 cents to buy another put below, and that will dramatically adjust this trade. So you could go down here and you could, buy the 550. Max loss is now $7,000, max profit $2,000, still 94% probability of profit. And in the event of a sell-off, this would actually help you quite a bit. And you can even increase those number of put contracts. You could buy 2 and do this for a small debit. This would potentially, if there was an IV increase, this could potentially make some money. It depends on how far into the trade it is, though. You can see this. Today, it wouldn't help you at all if there was an IV increase. But over time, even this doesn't really help having those puts that far down. Your puts have to be close enough. This value of death has to be smaller than this, because this is a $7,000 drawdown compared to a $2,000 position. Those types of hedges are tricky. So when you're hedging, you have to have some sort of decay in your account. Can you put the trade in the chat? Thanks. Sure, I will do that, Frank. If I get to a trade that I like, I will absolutely put it in the chat. But you can see you guys can screen grab as you go, because I'm adjusting the trade to kind of say, well, where would this work? Like where would I want it to be a hedge? All I have to do is drag this to a point where if I was buying that 605 put, 2 of those. But the problem with this is I'm entering it for a net debit. But this gives me a true hedge because the T0 line is negative. And it would be negative from today. If the IV increased, if we just reset all of this, if the IV increased or the market started to sell off, we have a negative profile on here. So it's short delta, and it's currently short delta just 0.8% or 0.08. but that delta would increase if the sell-off was bigger. So even though there's a valley of death here, the valley of death is small enough that this would create a downside hedge. And what's the cost on this? This is where your margin cost comes in. So the max loss on this is only $2,000. So this might be a very, very smart trade to put on. The problem is it's open for a debit. So if SPY doesn't drop, then you have negative theta decay. It's pretty low, but it's losing $4 a day. And over the course of the next 45 days, the trade is likely going to lose $230. This is why the probability of profit is so low, because there's only a 19% probability that it's going to fall into the range at expiration. But that's what hedges do. So they have a decay. If you've got a large account and you want to add some protection, this is something you might consider, spending that $200 every 45 days to give yourself a little bit of downside. I've got a fantastic SPY hedge on right now. Won't get into the details of it, but it is similar in style to this, but it's using short shares, and which have a little bit of decay to themselves because I have to pay the dividend. I also make a little bit of money off the margin. It's a little bit nuanced, but the trade setup is fantastic, and I have a very similar profile to that. So rather than trade the Black Swan hedge that I have, I am trading a different type of SPY hedge, and that is available in my Patreon account. You guys can see all those adjustments. You can see exactly what I've done and how I've traded that over the last little while. If you're interested in that, I'll probably make a video on that at some point in time, because I think that the Black Swan hedge video needs to be replaced with what I'm currently doing. And it says, thank you, you're very welcome. Okay, so nobody gave me any info on any stock. So let's pick a stock between $100. It has to be high liquidity. I don't want like some random name. So it's got, it can be Meta, Google, Microsoft, Apple, Amazon, any of the big. We could look at any of the big Mag 7, but maybe you've got another stock you want to look at. You want to look at Autodesk. So let's throw in some trade ideas. Meta. Okay, great. Thank you so much. So who was that? David. Thanks for the Meta suggestion. So let's take a look at Meta. And what I want to do, the goal here is to set up a zero loss trade. So Meta, as you can see, we're just looking at the chart, like what has it been doing? It's actually in quite a nice range right now. It's been moving, up and down across this price point for a little while. We can see the high here at 796. We see a low over the last couple of months of 479. This is extremely wide. Now, if I was a stockholder in Meta, if I was to buy stock today at 658, my expectation would be that this would be a bullish trade. I would want to make money to the top side. But when we have accounts that get to a large size, sometimes what I want is a position that is just guaranteed to make me some money, and there's still some potential in it. So my first choice would be something like T-bill, or if you're Canadian, you can use like cash.to. So what do these do? So let's just for a second, we're gonna look at T-bill, and here we go. This is the Treasury, and basically what these do, the chart's really boring. It just goes up and down, and it pays out a dividend equal to the amount of the movement. And if we were to buy this today, we would pay $49.91, and we would collect $15 per share each. What is this? This is every month. So we get 15 cents per share against $49.91. Now, if we use our calculator on that, let's just run that math. What is T-bill paying right now? So if we get 15 cents times 12, that's going to be our annualized return is $1.80. We're going to divide that by $49.91. We're just trying to figure out the percentage of what our potential is. So buying T-bill today, we're looking at around 3.6% return on capital. What if I took a slightly different scenario with my money? So let's use an amount of money that's a little bit bigger. So 3.6 is our baseline, right? So Meta Platforms is 658 right now. Pretty expensive, but so how much would it cost to buy 100 shares of this? It would cost $65,810. So let's just use a kind of an even number, $66,000. Okay, you guys can see how I'm deriving that. So I'm assuming that I have $66,000 that I could buy Meta stock with, and that I could put into T-bill. Now, if I put it into T-bill over the next year, I'm going to make 0.036, right? So $2,376. That's how much my return is going to be. We're going to break this down into a daily. So we're going to say, how much is this daily? 365. Over the course of the year, we're making $23.76, and we're going to make $6.50 a day. So that's kind of our baseline if we had $66,000. Now, instead, what I could do is I could buy stock. Now, if I did that, I have risk. If the stock drops back down to 580, I lose money, right? My 66,000 is only worth 58,000. I've lost $10,000. So there's a considerable risk here that could happen, but there's considerable potential as well. Now, this is not for money that I'm looking for speculative investment. This is money that is the portion of my account that I am saying I want to have some safety and I want to have a guaranteed return on capital. So I'm going to put in a trade that, as long as I manage it, it's going to have no risk. It's going to have some return, just like it would with T-bill. Okay, so we're going to go to the options chain. Now, typically we look out about two months from now. So it's got earnings, it's got a dividend coming up, which we would collect if we were in this trade, which would be nice. Let's look out at February 20th. It's 73 days away. That what we know is that if we trade our cash for buying stock, then we are going to lose out on that 3.6%. And that 3.6% is built into these prices. So what I want to do is I want to find a butterfly. And typically I do this with calls. So I want a range that is as wide as possible. So I'm going to start by centering on the 660, which is what we're trading at right now. It's the at the money calls. And I'm going to set up a call butterfly. So what I do with this is I've got the 660 call and I have selling two of those contracts. Now let's go down to, I want to go as wide as possible. So let's see if I can set up the 630 call. So this is a $30 wide butterfly. We're going to go up to the 690. And what this is doing is it's showing me right here that I only have a 32% probability of falling in this particular position. Max, this is not right. Let's get those to the right contracts. Those buying are only one contract. So I'm buying a 630 call, I'm buying a 690 call, and I'm selling two of the 660 calls. That's what's happening here. So selling two, buying one. And this creates a bullish call credit spread, a call debit spread rather, and then a bearish call credit spread. And the profile of it, we're going to see here, probability of profit is only 18%. Max profit is $2,660, but the max loss is actually really small, $340. So what we can see here is we have a break even between 633 and 686. This is a cool setup. Let's look at the curve. It is just because it's so small. Because I know that I can trade my stock, my cash for money, what I can do is I can replace this purchased call, this lower purchased call, the 630. I can replace that with a long stock, long put position. Okay, that is the same as buying a 630 call. I'm going to be paying some extrinsic value for that. It's a cool setup. What happens? So let's go to the table. Very simple. The 630 call, I'm going to change that to a put. So I'm still buying, I'm just changing it to a put. And then I'm going to go down here and I'm going to add buying the underlying, buying meta. And what that does is it gives me a trade that if I was to put it on today would cost $62,800. Now the cool thing is that it's protected to the downside. What happens in this situation when I have a married put on? So this 630 put means that if the stock was trading, let's say that the stock went to $500, well, I have a put in here that guarantees that I'm allowed to sell these shares anytime over the next 73 days for a price of $630 per share, or $63,000. That $63,000 is greater than the amount that I'm putting into the trade right now. I'm only putting in the $62,800. So when we look at this curve, you're going to see something very interesting right here. You're going to see that the probability of profit is 100%. We cannot lose on this trade. And the reason for that is because of this higher interest rate that we're incurring right now. if we purchase this for 628, and as long as this is managed correctly, if we pay attention to our count, then as long as the 630 put is in play, it is protecting our downside. Now, if the market moves up, the stocks are making money, but these call spreads are losing money. So we have this put would lose money, and then we would have 2 of these 660 calls that we would have to buy out, and we also have a 690 call. But this is what I want. I want effectively 100% trade on, and that's how I set these up. Now, what is the maximum profit that I can get? Let's calculate this out over the course of the year. We know that if Meta falls down into one of these wings from now until February, which is 73 days away, let's just say the stock was trading at $606, then the profit is going to be $202. Let's just call it an even 200. And on the top side, we're going to see that same thing. The expiration P&L is around $200. So we can see what happens there. What that means is that this, over 73 days, if we were to do this trade repeatedly, the minimum return would be $200, whether the stock goes up or down, every 73 days. So let's do that math. 200 divided by 73, we're going to get $2.73. Now, remember, our potential profit of T-bill was considerably higher than this. We were like $6.50 a day, I think. So if we did this every 73 days or for the whole year, and we fell into the minimum range each time, this would return only $1,000, which is substantially less than the $2,300 or $2,400 that we were going to get. So let's do the math. This is $63,000 trade. It's slightly less than the 66,000 because that's the price to enter is $63,000, and so it works out to 1.5% compared to 3.6%. So the risk is making less money, but we also have this potential, and that's the cool thing. Now, this trade in a single 73 days could make up to 3183. So let's do that math to see what our top end range is. So 3183. Now it's very unlikely to hit this, so don't be getting too excited about it. We divide this by 73 days, and then we get our daily, which is 4360, and then we times this by 365. So this would give us potentially at the max a $15,915 return. And we divide this by the total output, which is $62,800, which is how much we would have to put into it. So we're going to call that 63,000. So this is the very max. So the maximum this can make is 25%. But this is a cool thing to think about. What we're doing is we're taking some money and we're saying this could make somewhere as low as 1.5% return, and we can go up to 25%. We're likely going to fall inside of that. And the idea is that with this large butterfly, we want, here's our range, 630 to 690. That's our profitable range for the February date. So if we go to the chart, we would mark on here. We would come down here and say, let's draw a line at let's draw trend line, horizontal line at 630. And then we would draw a horizontal line at 690. So you have to trade this on things that you think are going to stay in a range, and Meta might not be the right one because the likelihood is that it could just zip in and out of this. It hasn't stayed in that range at all. Whereas if you set this up on like Visa, you would find that this range that we're trying to collect, Visa very rarely trades outside of that range. It's shocking how often it falls into it. And it can be adjusted every 2 months. So you could theoretically really mess up the trade by adjusting it to at the money all the time, and then having that stock kind of swing out into that lower profit range every single time. But what I'm trying to show you is that there's ways to have a return that's protected where we can make some money and we still have potential, because making up to 25%, like even if we were to make 10%, which is pretty good, that is 3 times the amount of money that we would make in T-bill over the same course of time. So if we were to do that on an annualized basis with that portion of our account we normally play T-bill, then there's potential that you could like really compound over time. We can make it a little bit different. So I'm going to type in, if you guys asked, yeah, and this is a cool thing. Let's actually, I'm gonna put in the trade as it's centered right now. So I'm just gonna type in here as I would. So it would be long stock 100 shares, and then I would be plus the 630 put, and then I would be short the 660 call. Let's just make sure I'm talking about this correctly. I'm gonna go to this is the 660 call, and I would be short 2 of those. And then I would be long the 690 call. Now, the other thing we can do with this is we can just tighten it up. So I'll show you, the adjustments are wild because because we're dealing with this kind of base rate in there. So let's just tighten it. Let's just slide these in 635 and 685. The other thing you can see is we can make it asymmetrical. Say I thought that Meta was gonna go up. Well, I can really adjust my risk. Well, now, I have the potential of landing in this profit tent here. On the downside, I only make $100, which is like 0.75% a year. I still have the ability to make some money. This is not nearly as big. This is 2,500. But to the upside, I have expiration P&L of $600. So I could be long my stock, and if I thought this Meta was going to go to $700, but it may not, it may stay in this range, then I can still make a decent return, because making $600 off of this could be great. Now, if I'm really sniping it, and as David is asking, is to say, hey, can we actually center these calls right at the 700? And absolutely, that's the cool thing about this strategy. So we're buying that put, that protective put. We just have to get it to the place where there's no loss, and then we can spread this out. We can make that butterfly right at the 700. This one is a little bit narrower. It's between 680 and 720. So the expiration P&L is 400 to the downside, which is right darn close to that 3.6%, right? This is $428 in 73 days. $428. Is this going to cost a little more money? Yes, it costs more money to get into this. This is $67,565. But 428 is the downside, divided by 67,000. We'll call it 67,600. 67,600. Because there's a little bit of commission and stuff in there. So that's our total return on capital, and we divide that by 73 days, and then we times that by 365, and we'll get the annualized return, 3.1%. So this trade right here would make 3.1% compared to T-bill, which would make 3.5%, and it has the chance of making up to $2,400. So that's a lower return. That would be 2,400 divided by 73 times by 365. So this would be a max return of $12,000 divided by the 67,600. 67,600, and this would be 17.7%. So this trade setup makes somewhere between 3.1% and 17.5%. And as long as it's managed, it's fine. What are we worried about with management? Well, what could happen in this case? Let's just look through all of the parameters. Well, first of all, we own the 680 put. So as long as we deal with this prior to expiration, we control this. Nobody takes this away from us because we're the owner. We're buying that. Same with the 720 call. We also purchased that. The only portion of this trade that is at risk of anything is the fact that we sold some 700 calls. So we just have to watch that carefully. If the stock went to $750, if the stock went flying up here and these calls were suddenly in the money, well, once the extrinsic value is gone, when we get close to 73 days, there's risk of both of these being assigned. Well, what happens in assignment? When say the stock was at 750 and we got them called away, we got paid $70,000 twice. So we got paid $140,000. Well, the long shares are now gone, so that would be struck from the trade. and we would be short 100 shares that we paid 70,000 for, or that we got paid 70,000 for. Well, we could turn around and we could use this call. We could exercise this call and call them away from somebody else for a total of $72,000. Does that make sense to everybody? So we would no longer have the shares in play because the first call would have them called away for a profit. The other shares we would have collected, or we would be short and we would have been paid 70,000, and then we would have been able to call those shares. Now I'm confusing myself. We would be able to call those shares away from someone else for $720 and then sell them for $750. So we would end up in a situation where we were net the $2,000. That makes sense. So that's how that works. Then the put would be worth nothing in this case. They can be adjusted over time, but from I'll show you one of the trades. Let me just flip open one of the trades and where we are. And I'm playing it on Visa. I don't know if Meta, like looking at Meta's chart, it seems like it's a pretty wide range. So I wouldn't want to be in something that has such a wide range. So this is what my profit tent started on Visa, what it looked like when it started this trade. So I started this in July and I bought shares. So you can see I did the whole transaction. I bought shares. Sorry, scrolling all over the place here. We'll walk through the whole thing here. April 15th was the start date. The Visa was trading at 336. I just put this in as a custom trade. I purchased 100 shares. My option expiration dates were July 18th. So this is about 2 months out. The long put was at 325. This is my married put. So no matter what happens, I can get back 32,500 if the stock goes down. I then sold a short call, 340. That is a covered call. That's effectively what's happening. So I have a married put and a covered call situation. Then I sold a second call spread. I sold the short call at 340 and I bought a long call at 355. I did this total for a total debit of $32,400. You can see there. Now I know I can get 325 back, and there's my chart. So when I look at my chart, there's my potential. I could have made only $90 on this trade, and I have this little tent. Well, what happened? On May 13th, the stock was trading at 356. It had gone up quite a bit. It was actually outside of this range. But it paid a dividend, and I collected that dividend. It's $59 I collected, so I put that into my RORC. I didn't make an adjustment to the trade itself. I still had the July 18th 325 long, 2 at the 340, and long at 355. Then July 11th, we're getting very, very close. We're a week out. Well, where was the stock? It was trading at 351. It was slightly inside of my range. I could have waited. But it was close enough to in a position where these 350 strikes are the extrinsic value is starting to deplete when we get down to that little time left, only been a week left. And those are at risk of being called away from me, which isn't a big deal if it happens. But in this case, what I did was I made an adjustment. I rolled from July 18th out to August 29th. And you can see I changed my strikes. I went from the 325 to the 335. I went to the 340s to the 350s. I basically recentered this, recentered the butterfly. So when I put this on, I sold the 340s because it was at 336. Adjustment 2, 350, 350. That's what I was doing. And then it's still $15 wide. I did this for a debit. I paid $770. So this is adding to my net debit on this trade. It went from 32,000 initially. I collected a small dividend of $59. Well, now I'm 33,000 into it. What happened? So I've got the August 29th. Well, what happened? About a week before the expiration, stock was trading at 343. I remember I'm centered at the 350. So this is nicely in my profit 10. So I rolled out again. This time I recentered again. 340, I wanted to go a little bit below where Visa was trading. I'm doing a little bit of technical analysis here, trying to capture that peak. So it was very close to the peak. $7 off, and I'm just moving it slightly below. I collected a credit of $1,271 for this, $1,271 back in my pocket to roll that out from August 29th to October. Then September 2nd came along, I collected another dividend, another $59. October 16th, which is just the day before the expiration, stock was trading at 341. My peak is at 340. This is like $1 off. That's fantastic. There was still some extrinsic value, but with a day to go, I didn't want this to move away from my peak. So I rolled this out and I just did it 2 weeks. I hit that kind of perfectly. So I widened out the butterfly. In this case, I made it wider. So it went from the 350 to the 352, 330 to the 327. So I'm still equidistant here. Instead of being $15 wide, I'm now $17.50 wide. And I collected $4 for doing that. Let's go down and find that chart, that particular move from October 17th to October 31st. So which one was that? This is October 17th here. So that's my green profile. And then October 31st is here, the blue profile. So sorry, this is the one post-dividend. So that was just the dividend that I got, the 59 cents. And you see how that, every time I get this dividend, it just adjusts it slightly by that $59. But there's now my profit tent on this trade. So what happens if it falls down into this area? Only make $1,300. Now, of course, the time is extending, but my peak just continues to track over the course of the year. And then my next trade would have been October 31st, trading at 338, and again, right close to that peak. And this is where I'm moving that to target it. And when we did that November 14th adjustment, so I went from October 31st, again, this was another big leap up because it was close to the center. You can see these latest adjustments have not been that great. They obviously weren't that close to the peak, but I've gotten twice, I've hit close to the peak where I've had a very, very significant uptick in how much potential I have on the trade. And then you can also see in my latest adjustment, is this the most recent one? Yeah, the December 19th, I've actually widened out again. So I've gone a little bit wider to raise this potential to 3,400, and the minimum now is 1928 if I was to just ride this to expiration. So let's just say that at expiration now, if I close this trade, 325 is, or 3250 is, sorry, 325, 32,500 is the guaranteed amount that I'm going to get back from this trade. So I would plug that in here. I would just say 325 is guaranteed. And from an annualized standpoint, I'm making 8.8%. That's if it closes in this outside of this range, below this over the course of the next week. I have potential if Visa rallies up that it could go up here, which would be very nice. And then it would leapfrog this again. Otherwise, I may just adjust the peak over, depending on where I think the stock may go. So that's kind of how that functions. But you need a way to be able to track it. I mean, this is why I built the rolling options record keeper in a simplified structure like this. I can track up to 24 adjustments that all chart on that same chart. And we can see, if we scroll down, we can see exactly how much money we would make at each strike. So if it was trading at $344, initially I would have made $1,100, then $1,169, $1,359, $1,670, and as we go, you can see that just is increasing over time because I'm making slightly more money repeatedly. But the goal is to make better than 3.5% while taking no risk. Was that help you guys? Just to make it more challenging, is it possible to replace the stock purchase with an at-the-money call? Absolutely. Changes the risk profile. So let's do that. And we'll chart it. That's a really good question, David. That I think that you'll see why. But let's just delete the stock purchase. And then what time frame do you want to do? I mean, you could do it with the same call, the same expiration date of February. You could just buy a call at the money, 655, and that will give you but the delta is not neutral here. You can see this. We have the max profit is huge because we're now long call. But what we have here in this type of trade is we actually have negative theta decay. So a long call is not helping that position that much. Okay, so it's making it a short delta trade. Now you can neutralize it if you want. Like say you go out to the table and you do a synthetic stock position, which I can't do in Mumu. But what if I was to buy the 38 put, or sorry, sell the 38 put? I would collect $3,800. So I would be net about $800 difference on this. And these are the type of things you can program into the Rourke. So let's set this up, and we'll set that up in the Rourke, and I'll show you exactly how I do it right from scratch. So we'll go over to a fresh page, and then we'll set that up. So do this in a custom sheet here. So we'll try to make it simple. Let's where am I going here? So many tabs, trade custom. So this allows you to set up whatever you want. In this case, let's do this one. This is the custom tab. So I'm going to just say duplicate, and then I am going to say meta, and we're going to do a meta zero loss trade, and then we'll set that up right here, start to finish. So here's the meta zero loss. Transaction date is going to be today. It's going to pull up the stock price automatically. Underlying price is 657.59. We're going to do, this is going to be a married put, long stock. Let's put an and, long stock, and call ratio. That's what this trade is. So we're buying stock. So first of all, we'll set this up with the expiration date. So we're going to go February 20th of 26. And what are the positions? We're going to go long put. We're going to go a short call. And then we're going to go a long call. And we wanted to center this at the, which one were we setting up? We're going to do it at the 680, 720, centered at the 700. And then we'll factor in that long call position once that gets put in place. So the shares purchased, $100 or 100 shares. The long put is going to be at 680. We're doing a $20 wide butterfly. So the short calls are at 700. There's two of those. We're doing the long call at 720. And there's one of those. You'll see the color changing happens. It just shows you which cells to fill in as you go down through this. And we would be doing this for a net net debit. What did it work out to? $67,600, right? No. It was more than that. It must have been 60. Let me just go to let me get it exactly here. So if we were to mark this on here, we're going to go minus, and then we're going to go add the long stock. So 659.26 is the mid price. 659.29. So we'll go 659.29. Plug that in, and then it's going to tell us $65,929. Transaction fees. There's going to be some fees in there, so we'll put in $10 for fees, and we're going to look at this chart in here, and something is really not working with that. What is going on? Long put 680, short calls at 700, 720. Showing me $100,000 profit on there. It's not the way it's supposed to be. 680, what have I done wrong? This is supposed to be a debit, that's why. Can't get a credit for something that's supposed to be a debit. Something simple. Okay, so we look at our chart and we can see that this trade is going to make a minimum of, does it work out to $2,000? Really? 659? 659, and we're going to, yeah, 65,926, and at minimum we get $68,000 back. So this is an extremely generous trade. Something is not right here. buy the calls. We've got to do the buy the put. That's why we changed this. This should be a put. 67, let's change that number. 67,570. Much easier to do when you're not live. So we're going to minus 67,570. This is going to give us a proper profile if we can put in a decimal. $67,570 with a guaranteed return of at least $68,000. And here's our profit profile. We have $430 profit. This doesn't include commissions on this. And then the butterfly is kind of charting off to the right. So we have to move the width of this chart. You can see right now it's showing $1 increments. So you can see 630, 640, 650. We're going to widen that out. So I'm just going to change this to $5. And then it's going to change it to a wider range. And then we can see what happens. At minimum, this trade makes $430. At maximum, it makes around $2,200. So there's how we would set it up. Now, what if we wanted to change this from stock to long call? So we would do the exact same thing. We would delete these shares. We would delete this net debit. And then we would copy what Moo has. And we would say, we're going to delete this and we're going to put in this long call. And the long call is going to be, let's go to the table, 655. We're buying this, the February 20th. So now, when we purchase that, the amount debit is going to be 64.80. We're going to put in, so minus 64.8, and then we're going to put in that long call. So let's do this long call, 655, and then minus 64.8, minus 64.8. So this will give us the chart, and it looks very similar to what Moo is showing. So this is why I wouldn't use a long call. But we could purchase do a short put against this. So that would give us a position that would be synthetic by nature. So let's do that. How much is this? I can't program it in Moo, but I can do it here. This would be a credit of 38.50. So if I program that into my sheet, which I can do very easily, I'm just going to make this little formula. So 64.80 plus, what was the number? What did I say? 38.50 credit. Plus 38.50. 38.50. And so this will be a net debit of 26.30, and there is some risk on this trade. Now, the thing about this is if I wanted to do something like that, I could probably get a fairly similar trade without having to do the synthetic position. I could just do a call butterfly, and I'll have a similar setup. So this one's got $130 risk and a potential of, up to $1,600. Let's see if we just simplify this completely. What if we go back to the drawing board and we just make this a call butterfly and we take out this position? How much is this? Well, here's that expiration P&L, 140. And then we have the 176.86. So that would be a smarter trade. I can just buy that trade, this more simplified trade, for just $145. So sometimes making it more complicated doesn't make the risk less or more. Now, the other thing I could do is I could just do this. I could put the money in T-bill, as I said before, knowing that it's going to make a certain amount of money. And then I can just pay this $130 and hope that it falls in the tent. That's effectively what we're doing. Now, there's a few advantages to doing what I'm showing you as opposed to running it in T-bill. In a margin account, especially, we have to pay returns, long-term or short-term gains. So for those Americans out there, it's very beneficial from a tax standpoint to own long shares. And then if the stock has gone way down, when you sell those shares, you actually get, you're getting a reduction in your tax base. Or if the stock has gone way up, you don't have to sell the shares. You can just continue to roll the butterflies over it. And then eventually, when you do sell the shares, when the stock has gone up considerably, you can take off you can sell those shares at that time and then have lower capital gains rate. So it depends on what country you're in. And I think there's a lot of flexibility in doing it with the long shares and tracking it that way from a tax standpoint. That's why I like to do it. Well, I'm Canadian. We pay based on what we're making in our margin account every year anyways. I don't have like a different rate for long-term or short-term gains. But from a tracking perspective, boy, does it make it easy. The other thing I can do is say the stock takes a wild swing to one side. Well, I can just get out of that butterfly anytime, still have my long stock. Like say the stock dumps and I want to take a quick directional trade on it because I think it might bounce. Well, I can just get out of the butterfly. If it bounces back up, re-put on the butterfly. That's where this has an advantage. You know, there's one portion where you're just rolling consistently. And then there's another factor where you're saying, okay, well, I actually want to roll. I want to take portion of this off. I want to take my safety off because the stock's already dropped, if that makes sense. There is one little thing, and I can't show you in Moomoo, but what you could do, so going back to that at the money call, let's go to the table and say, what if I was to buy that February 20th long call, but instead of selling the short put at 655 in February, what if I was to sell that at a lesser date? So what if I went just to January 2nd and I sold the 655? Well, I would get 1575 for that instead of the 30 something. So let's assume this and let's look at the chart. So we'll go back to our trade, and this time I'm going to put in 1575 credit. So we're going to go here, and it's still a short put at 655, but instead of 3850, we're only going to get 1575. This is where my Rourke, I think that this really excels. If you were to chart that in your brokerage, it would actually show you, a nice peak. Would be like a nice peak butterfly, and then there would be some loss on either side. My Rourke doesn't account for extrinsic value that or intrinsic or extrinsic value that could be included in the options for further expiration. So when you all of a sudden are diagonalizing this, and in this case, this would be a diagonal trade. So I'm just going to copy this down here and put this in here as a later expiration date or a closer option, closer expiration date in this case. So let me just change that format here. So December 19th, you can see what I have here. I've got the short put at December 19th rather than February. This shows absolute values of everything. There's no extrinsic value included. So it says right here, it does not include fees or potential remaining value of options with later expiration dates. So what this is doing is it's charting your absolute risk. And in this case, it's showing that you do have some risk. You could lose up to $2,400 on this trade. But what it's also doing is allowing you to trade this as a complex setup and say, well, hey, this option, the 655 short put, if the stock stays where it is at 657, this $1,500 is going to disappear in a week and a half, or in a week from now, right? 10 days from now. And let's just see what this chart looks like if you were to sell that 655 put for $15 again next week. So you do this, if you did this every week, you do the 1226, say, for $15. How does that change this profit profile? We can see the massive leap that occurs when all of a sudden you've got $1,500 of extrinsic value that's just been added to that trade. You do that 2 weeks in a row, sell $1,500. Well, this becomes an incredibly lucrative trade. This is using a synthetic position. So it's synthetic position. We take overall more risk, but what we could do is this February would carry over, and let's just say each week we were able to get, maybe this next week we only get $10. Sorry, that's not what I'm trying to do. Say we get $10 credit. So I type in $10 credit for rolling to January 2nd of 26. So this effectively what happens is the stock has been drifting up a little bit and I don't get so much money for that short put on the next sale. Well, it becomes a free trade pretty quickly. Of course, if the stock moves a ton, like if it goes way up to, you know, $800, it is a losing portion of the trade. But it allows us quite a bit of flexibility, and it allows us more complex trades than our brokerage will often show us. So you can see how I program that in. These red ones don't have the upper portion filled out. So the way my sheet works, you're supposed to fill in these white cells and it will reveal the next shell. So I would put in this adjustment would be, you know, next week I would be like 12/17 next Wednesday. Maybe I'm doing a trade, and then wherever the stock price is, that's how those adjustments work. Is that making sense to you guys? Do you guys like that kind of thing? Is this have you done this kind of thing before? Is anybody running this type of strategy? Because I know there's lots of people out there looking at the portions of their account saying, hey, I want zero loss trades for something. Let me know. It would be fantastic if you could let me know if this is if that makes sense at all. So the at the money call, just to be clear, that at the money call, I don't think is the right trade for that, because it actually gives you short delta. So opposite of what you would want in this particular case. So Ryan, you're learning something new. I love that. I love that you're learning something new. Yeah, and I don't have much else to say. It's lunchtime for me, so I'm gonna get into my chat room, see if there's any action over there. A pretty light trading day for me. I've got lots of trades. Cash secured puts have been fantastic. This last month we saw, you know, November was a bit of a drawdown, took some losses, rolled those out into covered calls, took some assignment, but everything's kind of coming up our way with aggressive cash secured put strategy that I've been running for the last little bit. And yeah, I'm glad you got it, David. That's awesome. I hope that was insightful. You know, I'm always trying to figure out things that might be inspiring to people to say, how can we set up something that has some potential for range trading. As I said, Meta, maybe not the best stock. You know, if you really want to set something up, look at Visa. Visa is a fantastically range bound stock and has very, very similar setups. I haven't looked at like MasterCard or American Express, but I would assume that those two have them as well. So especially if you're in a position where you're already holding 100 shares, or you're holding bigger than that, and you're like, oh man, like what if these drop? Well, putting on that butterfly can just flatten out some of the curve of our account a little bit, you know, and that's the end goal. Once we get enough money that we have to sit back and say, okay, well, how are we just consistently making money over time with still this ability to say, hey, we still have these like little lotto ticket plays, because making up to 25%, even though that's very unrealistic, it allows us quite a bit of flexibility with how we structure our taxes, which I think is important for everyone. Anyways, I'm going to let you go. You guys are fantastic. We're doing what everybody wants to do, which is we're getting rich together. So I appreciate the comments and appreciate you joining me today. I'll see my patrons on Thursday for our members only live stream at the same time. I'll see everybody else next week. Thanks so much, everybody. Let's get rich together. Take care.